The 4-year halving cycle, which historically dictated market peaks, has lost its predictive reliability. Bitcoin has shifted into a phase where price action is tied to global macro policy and institutional asset allocation. The current market coordinates show a period of consolidation near $69,000, following a decline from the prior peak of $126,000 reached last fall. 3 specific factors are currently influencing the market: expanding global liquidity, the establishment of sovereign reserves, and a structural exchange supply squeeze. This specific combination of variables forms the basis for current institutional price targets. Analysts now identify a projected valuation range between $120,000 and $170,000. This chart tracks the U.S. M2 money supply, which has reached $22.7 trillion and is growing at over 10% annually. M2 is a measure of the money supply that includes cash, checking deposits, and easily convertible near money like savings accounts. While global liquidity is rising, Bitcoin has recently shown a negative annual growth rate. This divergence marks a significant gap between the total money in the financial system and the current price of the asset. This shift is driven by the Federal Reserve's move to end quantitative tightening. Quantitative tightening, or QT, is a policy where the central bank reduces its balance sheet to decrease liquidity. With QT ending, the Fed is now targeting a lower terminal rate between 3.00 and 3.25%. Historically, this specific divergence between money supply growth and asset price has functioned as a leading indicator. In previous cycles, similar setups preceded market corrections of 40% or more as the asset price moved to align with global liquidity levels. The mechanics of the market have shifted due to the March 2026 executive order establishing the U.S. Strategic Bitcoin Reserve, or SBR. The SBR is a federal mandate to maintain a national stockpile of Bitcoin with a seize and hold requirement, effectively removing those coins from the tradable supply. Institutional demand is further restricting the supply side. U.S. spot ETFs recently recorded $767 million in net inflows over just a 5-day period. As a result, the volume of Bitcoin held on centralized exchanges has dropped to its lowest level since 2018. The combination of consistent EVF purchases and the Strategic Bitcoin Reserve creates a structural buyer of last resort. This framework removes a significant portion of the circulating supply and limits the downside risk typically seen in retail-driven bear markets. On-chain data shows the market is in a state of high compression. Bitcoin's 30-day realized volatility has dropped to a historical floor between 20 and 30%. This is reflected in the net unrealized profit and loss metric, or NUPL, which has slipped into the anxiety zone. NUPL measures the total profit or loss of all coins by comparing their current price to the price when they last moved. The current reading indicates an absence of speculative enthusiasm. Research points to a massive cluster of short-term holder cost basis between $80,000 and $85,000. Short-term holders, or STH, are market participants who have held their assets for less than 155 days. This compression of volatility and the removal of speculative leverage suggests that once the current technical resistance is broken, the lack of sell-side liquidity on exchanges could lead to a rapid upward revaluation. For current investors, the directive is to monitor the technical resistance level at $74,000. A decisive breach of this level would signal an entry into the $120,000 to $170,000 range identified by institutional models. The transition to a supply-constrained market is complete. As global liquidity conditions continue to ease, the lack of available coins on the open market is positioned to act as the primary driver for the next stage of price appreciation.